all the people that are on right now. We'll give it a couple of minutes. We'll do some quick intros. I wanted to start off with kind of the reason for the webinar to start with. Obviously, the world has changed a lot in the last 3 weeks, and we are all getting a lot of different information from a lot of different people, and our clients are all asking very similar questions. What does this look like moving forward? What does deal flow look like? What are you guys hearing on the phone? So we thought to get together a group of experts that we have here assembled with us that can talk a little bit about what that's looking like now. Obviously, things are changing rapidly and daily and weekly, so what we're hearing today could be different here in the future, but thought today was a good time to at least start with what we're hearing. So with that being said, let's do a couple of intros. Tom, you want to start us off?
Yes, my name's Tom Conkle. I am the Executive Vice President and Director of Commercial Services for Stewart Title Guarantee here in the U.S. So I oversee our commercial real estate platform for the title company here for the U.S. So, Adam, thanks for having me a part of it.
Perfect. John?
Hey, everybody. I'm John Fletcher, Denver native, run our valuation advisory practice for Colliers International here in the Rocky Mountain region. I oversee, all of our different asset types, but obviously multifamily is a big part of that. Several folks on my team that pretty much almost do nothing but multifamily. So looking forward to discussing the current situation with everybody.
Perfect. Jason?
Hello, everyone. Thanks a lot for having me on the call today. My name is Jason Hall. I head up the Sabal Capital, Fannie and Freddie small balance lending programs. Look forward to talking about what the agencies are doing in the marketplace today and, how it can help everybody, execute their business in the marketplace.
Perfect. And I'm Adam Riddle from Nexus Commercial Realty, Denver-based brokerage company specializing in the multifamily space, kind of all along the Front Range. So thanks everybody for coming out. So wanted to start out, each one of these individuals is probably getting asked the same questions over and over and over again for the past 3 weeks. So want to start out with some of those questions. Tom, you want to start out with just kind of what does closing deals look like now today versus 4 weeks ago for you guys?
Well, I'll tell you, it's a really fluid situation. I will tell you that probably as of about 2 weeks ago, 90% of our people are working remotely and from home, working on your closings and doing things. So that's been a change. People have had to sort of readjust and learn how to work with their clients remotely. I would say the biggest questions we have around gap and how we're ensuring the gap. And what I would tell you is that when the clerk and recorders are open, it's business as usual. When it's online recording, e-recordings, we're pretty safe and on e-recordings, and actually would prefer e-recordings in some cases. But when the clerk and recorder is closed, we have a completely different situation, and those are very challenging at best if we can close it all. And that varies state to state, county by county. So I would say, Jason, right now, the biggest issue around the issue with title companies is the gap and what's the clerk and recorders are doing and how we're sort of addressing that issue.
Can you tell us like a little bit more what is gap insurance for people that may not understand exactly what that is?
So gap insurance or the gap coverage is really the time period between when you close and actually record documents, when it becomes a recordable document. So in a lot of places, the recordation is immediate. We put the document for recording and it's immediate. In some places, there's a lag of anywhere from a couple days to a couple weeks. And generally what title companies do is ensure whatever that gap is between the actual recording of the document and, when we took possession. So in a lot of these situations now, where it used to be a couple days or a couple hours, now it's weeks. And so title companies are very cautious about intervening liens and things that might come in of record that we're not aware of. So I hope that did it. I hope that helped sort of explain what GAAP is. And I know from a lender standpoint, Jason, that's probably a really big deal for you guys that there's no intervening liens that come in between you and your first mortgage.
For sure. For sure, that's definitely important for us as well. So, working with the title companies it's been great, and like you said before, it's very, very location specific.
I will tell you the other thing to be prepared for with all title companies, all underwriters you're working with, is that I would expect everyone's going to expect a GAAP indemnity from the parties, either borrower or so. Don't be surprised when you start seeing GAAP indemnities on all your closings now.
Interesting. Very interesting. John, how are you guys looking? I mean, on the appraisal side, obviously you guys are kind of looking backwards in the rearview mirror, if you want to call it. Obviously looking in the rearview mirror, 6 to 12 months backwards, we've been in a great market. It's just here in the last 3 weeks, we've seen such a change. How are you guys personally looking at deals in your appraisal department, but also how are the lenders requesting you look at deals right now that you're underwriting and appraising?
Well, we've definitely gotten away from, I think early on when the pandemic started, a lot of appraisal shops, we were just saying, hey, it's too early to tell, we don't know. And I started getting a lot of emails within a week from most of the national lenders that we work for, regional, local as well, saying that, we don't want to just see a disclaimer statement that it's too early to tell. We really need to have a consensus of what you're hearing from market participants, whether it's lenders, investors, the brokers, get up to date as current as possible on what's going on. And really, as you say, we're always kind of looking in the rearview mirror. That's just how the process is built. But it's been kind of interesting here to really have kind of more of the latitude really from the marketplace to try to make our best estimates of what is the potential impacts to value, whether it's from a collection loss standpoint or how we may adjust comparables given certain market or circumstances. So we really are doing it, at least I know within our firm, we're really trying to do everything we can to be as forward looking as we can without delving too far into either being overly optimistic or pessimistic. And every day I'm hearing examples about stuff that people thought was too extreme one way or the other. So I can kind of dive into some of the specifics more if you want now, or I don't know how you may want to cover it.
I mean,
I'm open to fielding questions as well.
Sure. I mean, that brings up a good point. I'll just announce to everybody that's on the call right now. This is going to be a lot of Q&A. We kind of have some things to cover here, but a lot of this is going to be just some questions from the participants that are on right now. So feel free. There should be a Q&A thing at the bottom of everybody's screen. So feel free to type in some questions there.
Well, one thing I guess I should chime in on, and at least in terms of comps, is we have to use closed sales. We try to use listings where it's possible. Obviously, there's been a handful of listings that have even been pulled lately. Those things are in flux, so leaning heavily on any current listing information is still kind of problematic. Really, where we're going to always try to use the latest and greatest comps, whatever's most applicable. Part of what we're looking at is, for those of you who are familiar with kind of how the appraisal works and flows, is we usually make an adjustment for market conditions or time since the sale took place up to the current date of value. And so in many cases, if we had previously been using, say, a 2-3% per year growth to trend those sales up to a current date of value, we're now flattening those out a little bit more, and in some cases down to 1 or none. I hear of some folks going to negative market conditions adjustments. as a way of basically adjusting your sales down for what's going on in the current market. I think where that can be problematic is that it may be appropriate on a property by property basis, but you're kind of wiping out all of the gains that have gone on in the market. And it's still not clear yet how much of a discount sellers may be willing to take in the current market. I mean, we're aware that, every buyer out there would like to get a good deal. They're excited to take advantage of some good interest rates and financing. But we have to kind of balance both those things out while we're making those adjustments. So I wouldn't be surprised to see most appraisals here for the next month or two with, comps that are effectively pre-pandemic breakout. And we're just going to have to adjust them as best we can. And it's really going to be probably another month or two before we start to get sale data in that, we're able to verify and talk about the issues. And, it's a good challenge, and it's one I'm kind of looking forward to. You spend 8 years of just kind of doing, hey, the market's going up and things are nice. So it'll be a good opportunity for us to really dive into what the market's doing here, and like I said, kind of a unique opportunity to try to be more forward looking in what we're doing, and try to provide that service to everybody with what we're doing.
Okay, perfect. Jason, you want to, you're a big, obviously Fannie Freddie lender, which a lot of people on the call, I'm sure, have their debt or use their debt or are looking to use their debt moving forward. Talk about the last 3 weeks and kind of where, I know there was some panic, but I think things have stabilized a little bit and what their expectations are moving forward. Talk a little bit about that for us.
So real quick, I just want to remind everybody on the call, I think what's really important is that if you look at Fannie and Freddie and, the overall big picture of Fannie and Freddie in the marketplace is Fannie and Freddie were created to create liquidity in the marketplace. So yes, the Fannie and Freddie of today is a little bit more stringent and there's new debt service coverage reserves. Your loan to value might not be the same as you got in the past, or your debt service coverage might have to be a little bit higher to get a deal done. But the agencies, Fannie and Freddie, they're in business. We're taking the applications. We're probably signing up a Fannie and Freddie loan still almost every single day. The loan to value is not the same. The debt service coverage isn't the same, but Fannie and Freddie, as I said before, are in the market to create liquidity and also to keep housing affordable. So during times like this, a lot of people are calling me and they're like, hey, listen, Fannie's changed. They're a little bit tougher on the new loan to value covenants, or I don't want to do the new 12 months of debt service coverage reserve. But, during times like this is when Fannie and Freddie really shine. It might be, like I said before, it might be a little bit, tighter and you might have to raise a little bit more equity. But at the same time, we're in the marketplace doing deals every single day. And, we specialize in doing the $1 to $10 million, kind of smaller Fannie and Freddie loans. But the same is applicable for the large balance loans too. I mean, the appetite is still there to do loans in the marketplace. It's just not going to be the same as it was before. One of the big things that we're seeing across the board too, if you want to, if you look at Freddie, everybody knows that Freddie locks rates day one. So that is still a really, really positive and a great attribute to that program, that you can lock rates day one. If you look at Fannie obviously floats with the marketplace, and you basically, you lock your spread, and at the end, you will close your rate, according to what's going on with the treasuries at that time. So, there's a couple different things that have happened with Fannie and Freddie over the last couple of weeks, just to make sure everybody on the call is aware. I'm not going to go into every single detail of how the programs have changed. What I'm going to say is the big highlights of the program is that, if you look at some of the reserves that are going to be required now. So the biggest thing to think about is at a closing of a Fannie and Freddie loan, you're now going to have to, provide a debt service coverage reserve. Freddie Mac is 12 months principal and interest. Fannie Mae is 18 months, principal and interest. Those reserves, will be kept for, until you meet certain parameters, whether you have a Fannie and Freddie loan. And then you will, obviously, if you need to tap into those reserves, you will basically have to, fill out the paperwork and ask for, say I'm not able to meet these covenants and these requirements, and I need to, to tap into some of the dollars that are in those impounds in order to pay those shortfalls. So, the biggest thing that you're seeing is those reserve requirements. Obviously, there's other credit enhancements, and I would just remind folks that this is that the Freddie program and the Freddie program and the Fannie Mae program in small balance have not changed. What we have changed is, and I'll call this credit enhancements. They're not credit changes. The things that you've seen change today are kind of COVID-19 credit enhancements to make sure. I mean, listen, at the end of the day, we all want to do, we want to place, great loans in the marketplace, and we don't want loans to go bad, as soon as you place them. So, that's a little bit about the principal and interest reserve. There's also, there's other things I can go into, later during this call, but, I don't think a lot of folks on this call have issues with maybe commercial income. A lot of the commercial income won't be accounted for today. It's more of the issues that we run into in Chicago and, in New York and places like that. But unless it's a really critical supply chain kind of tenant, you're not really going to get a lot of commercial income today. A lot of the things that you're going to see too is, your acquisitions will still be, are still the same credit parameters on loan to value debt service coverage for acquisitions, but your cash out refinances are going to change a little bit. So what you're going to see on Freddie Mac is you're going to have a 5% decrease in your loan to value, and a 0.1 increase in your minimum debt service coverage requirements, depending on what market you're in for your cash out refinances. So, there's a little bit more stringent there on your cash out refinances, but, acquisitions, I'm not going to say you'll get there, but, still you can get to, with Freddie Mac, you still get 80% in your acquisitions. I'm not going to say that we're seeing that right now, but that is still an opportunity in the marketplace. And, if, overall, the big picture on Fannie and Freddie, besides the fact that, we're actively still in the marketplace, is if you look at nationwide, you look at your top markets, you look at your small markets, your very small markets, with Fannie and Freddie, you still have the best non-recourse, highest leverage option in the marketplace. That is, that you can basically still execute and get deals done. As I said before, you're gonna have to bring a little bit more equity to the table. You're gonna have to put up a couple of reserves during these COVID-19 issues. But at the end of the day, we're open for business. We're doing, we are, especially at Sabal. I mean, Sabal today is, like I said before, we took in 3 or 4 Fannie loans yesterday. We took in a couple of Freddie loans. So the market isn't as robust as it was a couple of weeks ago, but we're still very active in the marketplace, executing the business. And, I think that people are still out there looking for loans, and the rates. I mean, truthfully, I know the rates were great 3 weeks ago. They were off the charts great, like probably the lowest rates we've had in the last 5-6 years. But if you look at where the rates are today, I mean, we still have great rates today. I mean, you can be in the high 3s to mid 4s, depending on where you are. And, depending on what type of product you want, you can be, between, 4 and 5%. So hopefully that's, maybe a little bit too much information. I mean, there's a lot of finite details with what goes on with Fannie and Freddie. I mean, I'm not going to run through each specific one, but just to highlight some of the bigger issues that folks are dealing with across the board.
For sure. No, that's an interesting point that I've talked to everybody on this call a few times over the past few weeks, but we definitely saw a strong fall off kind of immediately following the stay-at-home order. But in the last 2 weeks, have seen a tick back up. And I think people, whether it's a belief in the stock market doing better or just the initial shock of what was going on, but we are still seeing activity on the buyer side, and everybody obviously I think is putting a little more timelines, longer timelines on things, but we're definitely seeing some activity. But when I always like to compare what's going on the activity side, I like to call the title people, because that's where everybody's got to go to close the deal. Tom, what are you guys seeing in the last 3 weeks on the new orders?
It's interesting. We had a really strong March, especially the end of March, and I think what I'm talking about is closings, and I think a lot of that was deals that were teed up and sort of buttoned up. People really pushed to get them closed. So we finished the quarter really strong. I would say, sort of geographically, orders remained fairly strong through March. I will tell you they are trailing now. Our new open orders on transactions are definitely dropping. We have a fair amount of closings. I wouldn't say we have a lot canceling, but we have some pushing into May and June. So I would say our our order count is definitely going the opposite way it was in early March. Probably, if you do a comparative analysis, we're probably about 25% off on new orders versus this same time period in March.
Interesting. We were talking yesterday, Tom. What can people expect as far as timing? And we talked a little bit about fraud right now and how big of a deal that is for you guys.
Yeah, I think everyone, and Jason can probably, as a lender, and can talk about this, but one of the things where everyone should be prepared for what might have taken, 8 hours 4 weeks ago now takes 12 hours. And because people working remotely and getting used to the new reality. The other thing I think everyone should be really, really careful and sensitive about is wire fraud. We're being really, really careful about people ghosting transactions and getting in the middle of things, which people have become a lot more sophisticated about. So if you have title companies asking you more about wiring instructions and double checking and verbally checking wire instructions, please be patient around that, because the title industry is very cautious right now about wire fraud and people jumping in the middle of transactions. And, Jason, I don't know from the lending side if you guys have, I know we've addressed it specifically about putting more checks and balances in confirming, actually doing a little bit more than we traditionally have done as far as confirming wires by email, following up with phone calls. So don't become frustrated when the title company calls and asks you if the wire instructions you sent are legit, because they're trying to protect your assets. Jason, I don't know from a lending standpoint how you sort of view that.
I think that the overarching picture of the marketplace is, I tell people all the time, I'm like, listen, if you think, everybody used to kind of, they sign up their deals, they get the information in the door, and they kind of move the process along. Now is one of those times where you want to get everything done as soon as you possibly can and get everything really buttoned up at the very beginning. Because, if you have, every deal is getting a little bit extended. Everybody's, it's taking longer to do inspections, longer to get the, do title. I think overall, I think that, the title companies we're working with, everybody's been very, diligent about making sure that happens. But I think every single deal is taking a little bit longer today. And what we're trying to tell people is just really make sure that you get your information in as soon as possible for those transactions, whether it's an acquisition or a refi. I think that, overall in the marketplace, I think, we'll probably get into this a little bit, but, I think the collections coming up into the future is probably the biggest issue that we're facing today. Making sure that, I think a lot of our acquisitions have, some of us have stayed the course, and some of them kind of fallen out, but, T1 trailing 3, trailing 12, and comparing that to your T1 collections is probably the biggest factor that we're facing today. And I know that luckily the wire side of the game, you guys have done a great job of making sure that everybody is very diligent about that. So.
No, that's a good question. And it's actually a question from a participant too. Maybe for Jonathan, like how are you guys going to look at, are you projecting out impaired collections for the next 3 months, 6 months, 12 months? Are the agencies or just even the local regional banks asking you to project out certain things, or are they varied what their requests are from you on the appraisal side?
None of the lenders are coming out and specifically saying that they want to see a certain amount of time. They're just very adamant that they want to see the issues addressed. I would say that on the multifamily deals, almost everything we're doing right now, we're trying to estimate some kind of collection loss for whether it's probably at a minimum of 3 months. In some cases, we've gone up to 6. It just kind of depends on the tenancy, the market, how much risk is there in the property. And just so we're clear, when we're talking about collection loss, we're looking at the total potential gross income on the property. Anything from utility reimbursements, all those different things are going to be lost. So when we're doing that calculation, we're trying to factor in all that. Something that may bring that number down a little bit is we're only doing it against what's stabilized occupancy. So we're not going to try to ding it for, say, an additional 5% of something that you wouldn't typically be underwriting anyways. But that's at least within our firm platform, that's kind of more the standards that we're kind of going to right now. We're trying to be cautious, not like I said, even just using the word standard. Every deal is different. If you're in a strong market, high barriers to entry, strong resident, tenant profiles, we're probably not going to ding it as much. So typically what we'll do is we'll have it more like, we'll try to hear what we, now that we've got April in, we'll try to check in with you and say, okay, how much are you off for this month? And so for April, we could say, fine, if you're off 15%, we would say, fine, we'll just estimate 15% month one. A lot of folks are concerned that May, June might be more painful than April. So maybe in some of those months, and I'm just giving example numbers here, maybe in those months, we're saying it's a 25% loss. And part of what we're trying to weigh into those percentages lost is we know that some residents may take those government assistance checks and get caught up on rent. Some folks might try to get caught up on rent later on. They might pay back. I mean, you never know. Maybe that's overly optimistic. So there's a lot of different things at play in those numbers. I think the main thing we're trying to do is just catch that, we're always trying to put our buyer hat on. What would a buyer be thinking if they had to do this deal today? I think most people, if you're getting into a deal today, you'd want to have some kind of cushion there for some collection loss here over the next 3 to 6 months. So, you can dive into the weeds pretty far with all that. And I think one thing that may push up those percentages just kind of depends on, like, let's say you're a smaller property, you just started implementing utility reimbursements. That income stream could be a lot more suspect now if your residents just got used to that within the last 6 months. That they might push back quite a bit. You might see some more collection problems in those circumstances. So we're really trying to make sure that, we look at every deal as a unique animal and weigh in all those factors. So I've seen a few folks push out to 12 months. My current opinion on that is I feel like that's a little too conservative, with, as it's already been mentioned, stock market, there's some positive indications out there. I think most of the market consensus is that we're still hoping that this is more of a short-term problem. So at least not within Colliers, I'm not aware of too many reports that have used anything like a 12-month concession loss period. I think 6 is where a lot of them have been maxing out. And so that's kind of it in a nutshell. And if you guys have more specific questions on that, I'm happy to try to dig into it.
Adam, if you don't mind, I'm going to ask Jason a question about, there's a lot of, I don't know if it's misinformation or information going around about when you're in forbearance, what that looks like as far as new loan applications.
That's a great question. So it's actually moved around a little bit. So, hey, real quick question too, Adam. So the Zoom webinar chat, yep. Is that, so if questions come to me, does that everybody seeing this on the whole platform?
I see it.
I think the four of us do.
Do you want me to address these questions? So Andrew asked a question, but I just answered on there. Is that all I need to do?
Unless you feel like it's a good question for everybody. I'm getting them on my screen.
Okay, so you're getting them. Okay, so Andrew's question was answered. Okay, so I don't have to do anything. So here's what people need to know about forbearance. And I'm not bashful about saying this, is that, obviously I think forbearance is something you need to do at, if you really, really need to do it. I would recommend not doing forbearance if you don't have to do it. During forbearance, there's a couple things that happen during forbearance that I think is really, really important, and people need to understand this. And there's Fannie side of forbearance and there's Freddie side of forbearance. During Fannie, so if you go into forbearance during Fannie, you cannot evict tenants. During the repayment period after forbearance of the next 12 months, you cannot evict tenants either. Freddie, you cannot evict tenants during forbearance, but then during the repayment period of forbearance, you can evict tenants if you follow state and local laws and federal laws. So the reality is Fannie and Freddie are very different on whether or not you can evict tenants and how you can evict tenants. And then moving into the second piece, which is what you asked about getting new loans. If you are in forbearance during Fannie and Freddie, you cannot receive a new Fannie or Freddie loan. And I think this is really important. And if you look at the last downturn, for all of those who were around during the last downturn, a lot of people capitalize, buying new opportunities with Fannie and Freddie loans during a downturn, because as we see in the marketplace today, banks are already getting tighter every single day. Whether it's they're even doing deals, whether they're retraining deals, or whether or not they're only doing deals with their best clients. And so having access to Fannie and Freddie during a time of uncertainty is a great resource to have as a non-recourse, higher leverage loan that you can utilize in the marketplace. So the answer to your question is, during forbearance, you cannot do a Fannie or Freddie loan if you're in forbearance. So I kind of gave you a little bit longer-winded answer, and I answered two things at the same time. But I think that people need the biggest thing to understand is how the process works with forbearance, whether or not how the tenant situation works, and then also how the repayment situation works, and whether or not you can get a new loan. So those are important factors that I think that are there. And the reason why there was a little bit of, I guess, market confusion is that some of the rules, this week, or call it the beginning of this week, everything was really, pretty much buttoned up and finalized. And I do think some things might change, but over the last 2 weeks, some of the requirements of Fannie and Freddie and what was going to happen in forbearance reserves, things of that nature were being fine tuned.
Yeah, thanks. There was a lot of chatter going on around about that, and I think I'm glad to get some clarity.
Originally, it came out that you could for one of the programs, and then they changed it. So the reality is you can't get a loan if you're in forbearance with Fannie or Freddie.
Okay.
On a small.
And that's a good, just kind of thing to bring up, because obviously besides Fannie and Freddie, a lot of the local, regional, and national banks are doing some sort of loan modifications for a lot of these multifamily assets. So just very important to understand all of the details behind that, whether it's through Fannie and Freddie or through another lender. You have to know the details. Sometimes it sounds a little better, than it really is when you dive into the details. So
I think you hit the nail on the head. The amount of people that call us to ask forbearance questions and who are actually following through with them is probably, like, the amount of people call to who execute the forbearance is probably about 30%. But as we say is, the interesting thing about the forbearance period as well is you don't actually have to take, it's not like a forbearance is offered today and you can never have it again, right? So forbearance is offered for the next, call it 2-3 months, could be extended longer, but you can ask for forbearance next month. You can ask for forbearance the month after that. And then you get 3 months of forbearance, and then you have the 12 months to pay it back. So the reality is you don't have to take forbearance today. I think that, it seems from across our portfolio, it seems like there's a lot of people paid rent in April. And I think a lot of the challenges, I think all of us are kind of holding our breath, figuring out, are people running out of dollars during April and they won't pay their May rent. So I think that, all of us are trying to figure out what May collections are going to look like. And April collections came in, the NMHC came out that said a third of the people didn't pay their rents. That's not the case with our portfolio. And I don't think it's you, Adam, you and I talked about that last week too, is I don't think a third of the people are not paying the rents. I mean, a lot of them, I've called a lot of property managers that we know, that we work with, and most of them are in the 95, 96 percentile. And, a lot of them, yes, there were some that came in after the first week, 2 weeks, but they're still maintaining some pretty good collections.
Yeah, and that's what we're hearing for sure around Denver, at least. So I'm going to try to we got questions coming in. And this is something that we've been asked a lot on the buy sell side. It's probably a question for both John and Jason. The ability, your typical process, you put it under contract, you do a regular inspection, then you do an appraisal and a lender inspection, without having potentially access to the number of units that you typically would see. How are, on the appraisal side, how are you guys handling that? And then on the Fannie Freddie agency side, have they bent the rules a little bit on being having the guidelines a little different moving forward on that?
I guess I'll start. Technically, USPAP does not even require you to inspect the property. So from a USPAP perspective, the legal laws that govern appraisal, it's all up between you and your client and whatever allows you to produce a credible report. We are seeing more leeway now from the agency lenders in terms of getting into occupied units, but that's about it. We're currently looking at a deal up in the Dakotas, and the agency was still saying, hey, we still want at least at a minimum an exterior inspection, go see the common areas, get into any vacant or down units, or any of that is possible. And then they're just allowing us to supplement with either tenant provided photos of their units, or if manager or somebody's going in there. I mean, obviously we want everyone to be safe. And I think the main thing is just like any deal, we're just trying to make sure we have a good sense of the property. As appraisers, we're not building inspectors. I'm not there to find all the issues and say how much it should cost to fix them, and we can do that in a rough sense. But most of our appraisals, even prior to this, we usually have an assumption in there saying that any of the units that we didn't see, we're assuming that they're in similar condition to the ones that we did see. So the sample size is a little bit less, but I think generally speaking, this hasn't been too much of an issue. I mean, unless all of the units are occupied, which is a good problem to have. But even in those circumstances, I haven't come across a deal yet where we haven't been able to get it done in one way or another. So it hasn't really held us up too much.
Just from the agency side of the business, we have been, doing everything we can. Obviously, entering occupied units at this time is not required, but we're doing everything we can to try to get to see the properties. Obviously, we still have to go see every single property that would make a loan on Fannie and Freddie. We're doing everything we possibly can from certifications from the landlords to going to knock on doors and people opening the doors and going so we can see down the hallways, to going in, vacant units, seeing the common areas, as you said. Talk to the tenants. If the tenants don't want us to go in, we'll talk to them through the door. We've actually been doing FaceTime too. So at the property, we've been doing FaceTime where they can walk through the property while we're outside their unit, and they can FaceTime it, and we can screenshot that unit on FaceTime. We've been using that. So we can take pictures of the open doorway. We can verify running meters. We can do lease audits, so there's a lot of different ways we've been, we've kind of done everything we possibly can to try to make it as easy and for the tenants as well as for the landlord, and also so that we can do what we need to do so we can make sure that we're making a loan on a property that we know exactly what's kind of going on there. So we are worried about it a little bit. I mean, obviously it's a concern that you don't get the full picture, but we're pretty sure now that we have the process down and we're able to see everything that we need to see.
Perfect. I've got a couple of questions, probably more towards me, but I think Tom, you talked to a lot of people in the business around town and nationally, but kind of gearing towards an opportunistic acquisitions in the market and the percentage difference in between seller expectations versus buyer expectations right now. I can tell you on our side, we just had a larger deal fall out of contract because of this, and we circled back with the kind of prospects that we had lined up and got 2 or 3 offers that were at or almost beat the previous buyer. We've had multiple offers in the past 10 days that were strong offers, a little longer due diligence periods, as I said in the beginning, but we're not seeing a huge disconnect currently on the buy sell side. I think there's definitely buyers out there that are feeling like there should be more of a discount in the marketplace. I just don't think we see a lot of pain, whether that's a lot of people, like we've already talked about, paid their rent in April. So, most owners are just not feeling like they need to discount their assets at this time unless they have some pain in some other aspect of their life, stock market, oil and gas, or something else that they're involved in. But for us, we just have not seen a lot of pain on the sell side yet. People still feel like this is a kind of a blip in the radar and we're going to ride this out, and they don't feel like they need to slap a 10% discount or 20% discount on the purchase price to move it. Tom, what do you?
Yeah, Adam, we're seeing a lot of our clients have been saving their powder. There are a lot of people in the market that thought we were going to be coming into some type of recession at some point in the next 12 to 24 months. I think some of them feel like this is sort of expedited that. And so what we're seeing is opportunistic cash buyers that we've known that are coming, but right now they aren't seeing the discounts. As you mentioned, I think they feel like there needs to be a little bit more pain in the market to get the prices they want. I'll tell you the other thing, in talking to a lot of our clients, we're starting to see a lot of people writing in financing contingency clauses in their contracts. So if something is interrupted due to financing, that's an out. I've definitely heard that a lot more than I probably heard in the previous several years. But I think there is some cash on the sidelines that's looking to take advantage of the market, but I don't think it's there yet. I don't know about the rest of you, but that's sort of in the conversations we've been having over the last few weeks.
Yeah, Jason, I'm curious on you guys' contracts you're getting in for your deals. I know we've had a few that fell out 3 weeks ago that were passed, that were hard, and we had some interesting discussions about whether that buyer should get their earnest money back and what the court might look like. And now going forward, have even kicked out a lot of, to Tom's point, a lot of loan contingencies, and new offers have, where it used to be maybe a 30-day due diligence and 30-day, go hard after 30 days and 60-day close. We're seeing those, especially loan contingencies, being pushed almost till right at close because of the uncertainty of the debt market. Is that what you guys are seeing on your new deals coming in?
So the interesting thing about new deals coming in, I guess the only thing I'd say is that acquisitions, a lot of the acquisitions we had kind of, dried up a little bit. And most of that was just due to, you and I talked about this too, was folks are uncertain where April and May collections were going to come in. Some deals have moved forward just because people like the deal, they like the location, they wanted to keep moving forward. It was a lower loan to value deal. But, I would say that, the deals that are coming in the door right now are mostly a lot of refis. I don't see a tremendous amount of acquisitions popping up right now, unless it's some, high net worth buyer or lower loan to value deals across the board, if that makes sense.
Yeah.
And, I mean, the hard part right now is that, like I said before, I think folks are just a little bit worried about collections, but there's still, we're just seeing, I think refis are what we're seeing right now. I think that acquisitions, we're happy to do acquisitions. I think it's the same thing that you're seeing across the board too, Adam, is, what are folks, where folks are really comfortable doing deals, they're jumping in. And then there's some folks who are, probably 50-50. Some are really excited and some are taking a pause. Isn't that what are you seeing across the board? Are you seeing about the same thing?
Yeah.
Am I answering that question the right way?
Yeah,
I'm trying to figure out make sure I'm answering the right way across the board.
I would say, into March, it was a lot of, we heard a lot of pencils down, waiting to see how this all pans out. And in the past week, I'd say there's a lot more optimism in people's voices and talks of either they're starting to look a little more aggressively, or we feel like in another couple of weeks, we're going to get back in here. We're getting more comfortable with what this looks like going forward. But I would say for 2 weeks, it was a strong, we're not looking at anything, and we're kind of peaking as we're on the phones in the last 7 to 10 days. A lot more people are talking about, yeah, let's start looking again. Let's look at this. We'll underwrite it. I'm not sure if we can, we can put an offer in today, but I want to start looking and seeing what's the market doing today. I want to stay on top of what the market's doing, so when I'm ready to get back in, I understand what the market's doing today. So that's what we're seeing on the brokerage side, at least.
And that's, one of the things that's come up with these, and I'm trying to answer some of these questions that are popping in my screen and just make sure I don't know if I'm doing a good job at it or not, but everybody keeps asking about forbearance. Like, does it hurt your opportunity to buy a deal and use Fannie and Freddie financing? Just to make sure we go over this real quick, is that if you're in forbearance, it's not going to hurt your credit. And so this is just a little nuance, is that folks keep asking about their credit scores and things of that nature, is you're not going to hurt your credit, or you're not going to hurt your standing with Fannie and Freddie if you're in forbearance. Just to make sure everybody understands that, because that's a big piece of the puzzle. If obviously you go through forbearance, you don't pay them back, it goes into default. Yes, that will hurt you. But during the time you're in forbearance, you can't get a Fannie and Freddie loan. But overall, in the course of the period of your real estate career, if you're in forbearance, you pay yourself out of forbearance, or you get out of your forbearance with Fannie and Freddie, you're not hurting your reputation with them at that, for the future or your future credit. So hopefully people understand the nuance there. My point earlier on forbearance was, I would be cautious about forbearance because, like Adam's saying, people are looking a little bit, more opportunistic, and maybe feel there's good opportunities that pop up this summer or in the fall, and you want to use Fannie and Freddie financing. If you're in forbearance on another transaction, you can't use that financing at that time. And I just think that's a big piece to really be thoughtful about whether, do you want to raise new equity or do you want to, go into forbearance or, how you want to basically handle your transaction moving forward. Capital calls, things of that nature.
Right.
Adam,
and I'm trying to, and Adam, I don't know if just the only other thing about this chat is that, okay, so if we do, do we need to go through those and answer them at some point in time, or can we just answer them like after this call?
I'm trying to get to some of them. Some of them are probably a little too detailed that maybe we can answer offline with individuals. But I'm trying to go through as many of these as I can.
I saw one that, are you guys seeing a lot of new COVID language in contracts? Are you, you guys probably pay a little bit more attention to that than we do, but are you starting to see in contracts you're doing COVID language in there?
We are. We're using, at least Colorado, the Real Estate Commission came out with a COVID addendum, basically saying if we are in lockdown and or a individual that's party to the transaction actually contracts COVID, that everything gets automatically kicked out. We've been using another additional provision paragraph in our contracts that discusses that because, I think it goes back to the flexibility on it was more for, I think, deals that we had under contract that had dates coming up that were struggling to hit some of those dates. Most of our new contracts are being written with longer dates that we feel like are pretty reasonable on hitting, but we're still trying to put those in there because obviously nobody knows how long this lasts and what this looks like in the next 30 days. And the last 30 days has been a whirlwind of a time. And so, but we are definitely seeing more of that type language put in almost every one of our contracts. Maybe Jason, this might be for you because I probably can't talk to this as well as you can. The status of the bond market and the group's beliefs on what the bonds might be doing in the fourth quarter, where the bonds might go by the fourth quarter.
I have no, man, I was following the market this morning. No, but I don't have any idea what's going on. That I saw that question come through. I probably couldn't do a great job answering that. The only thing I can say is that, so everybody knows how Fannie transacts with, there's investors that buy the bonds, right? So investors buy the bonds for Fannie and Freddie. So what people don't realize is that Fannie and Freddie, a lot of the execution has to deal with how the credit markets are behaving. So, you have the stock market and then you have the credit market. So if you want to understand how Fannie and Freddie will be in the past, I think the more certainty we have around COVID-19, the gentleman who runs our CRE desk, who does, retail office, multifamily, it doesn't fit agency. And I asked him, I said, what do you need for the world to calm down and for the credit markets to make sense? And he said, I just need COVID-19 to go away. So I think the reality is, nobody knows what's going to happen in the credit markets and also on the bond markets, given the fact that, there's still uncertainty around COVID-19. But, that's kind of, if you look at the pricing just to give you some color is that, so Fannie, as everybody knows, fluctuates with the market and you close at the very, you close at the end with your rate. The investor spreads on Fannie loans has drastically it started off, call it 2 weeks ago, the investor spreads were flip-flopping every day between your best, it could be between 15 to 100 basis points on the difference that somebody would bid on a loan. And the investor spreads have become getting a little bit tighter. So I think that every single day, that people get a little bit more comfortable with what's going on, the investor spreads will get tighter and rates will get, will probably stabilize a little bit better. That's the only thing I can say. I think that anything more than that, I probably don't know what I'm talking about.
Jonathan,
looks like you want to answer one of the questions in here.
Actually, I was trying to type the answer because I figured it was pretty short, but we typically, one of the questions was the due diligence timeline for multifamily, and obviously the market slowing down a bit. The typical 2-week turn for a multifamily deal is pretty doable these days. I guess while I'm at it, there was another question about if you're appraising the same property 2 months ago versus today, are there any significant discounts? And again, the answer is it does kind of depend on the asset. If it's a strong asset, good market, we're not hearing a lot of pain on the collection loss, then yeah, you might see a little bit of a reduction in terms of the credit concession loss that we'd be calculating. But otherwise, until we have more comps data that really point us in one direction or the other, and like I said, just the general consensus of hopefully it's short term and nobody knows exactly just yet, we're reluctant to really start hammering values on things. But I have seen a couple deals that were kind of uglier properties in secondary, tertiary markets that were really getting aggressive with rents and things like that. So if that's more of the deal profile, you might see a little bit more of a head on the value there, since you're going to probably, your buyer's going to probably want a little bit more of a discount there. But we're generally hearing people say they want to see something like a 5 to 15% discount on the value. But as it's been alluded to earlier, we just don't have enough concrete evidence yet that sellers are on board with all that. So that's in a nutshell kind of where we're at with that.
Sure. Kind of a macro question here. People are talking about the next stimulus package. A lot of the previous one had to do with renters and small businesses. What is the group's belief in and what the next one might look like for on the landlord perspective to try to help some of the landlords out? Jason.
Say that. Go ahead. Go send me that question one more time. Make sure I really understand it.
Like
the next stimulus package.
Next stimulus package. What should it address to help the housing industry and the housing threats that we're all facing as landlords? We all understand that tenants are going through certain things right now and job loss, but we also have expenses and bills, and there's the forbearance, and local lenders are giving you 90 days and all that kind of good stuff, but that can only last for so long. So is there anything else that we feel like the stimulus package should help as far as the landlord side?
I mean, that's a super broad question. I mean, I wish I had a crystal ball for that one too. I mean, I think that, I think that folks, the stimulus package is coming out. It'd be nice that, the landlords can receive their payments so they can pay their rents, because obviously people are living somewhere and there's expenses that are associated with that. So I don't know. I mean, I think the forbearance is great, but at the end of the day, forbearance still, it still needs to be paid back, and folks are getting their stimulus packages and hopefully they use their money in the right way. I don't know. I mean, there's a lot of things I could say that I believe, but I probably not going to say them live that's recorded, but there's what actually should be done. But, hopefully folks use their stimulus package money to, pay their landlords and pay their rents. So, I mean, people need a place to live. I think that's what's great about our business, is that at the end of the day, I mean, retail and some of these other, retail and office are having a hard time, but, I think all of us, take some, no matter what happens, where cap rates go up and down, or people, if you're uncertain about the marketplace, like, people need a place to live. And, that's one thing that we all can rely on. So that's one of the nicest things that we have going on for ourselves. At the end of the day, people are going to pay their rent, hopefully, before they go to the retail center.
I just got a text offline, but someone's sending me text. And I think this is a question for all of us on the panel. It said, what's sort of the biggest reality we should face as clients? And I think those of us in the service side, whether it's appraisal, mortgage, brokers, I think we've all settled into the new reality fairly well. I think the new reality is things are taking a little bit longer. And I think most people are sort of understanding that, being patient. But I guess from my perspective, the answer to that question is we've really settled into the new reality much quicker than I thought we would ever have been able to be honest with you. We deployed, 7,000 people and 80% of them to work remotely within 10 days. But I would say, be patient, understand the process might be a little bit longer than it has been. But from my perspective, the answer to that question is things just might take a little bit longer. We might have to communicate better than we have previously.
Yeah, I agree with that. We're coming down to the end of the time. I had one last question for the panel, but I wanted to just throw this out there to anybody that's listening right now. My email has been out there. If you have a specific question or want to get hooked up with one of the people here on the panel to talk in further detail about something, I'm sure anybody here would be happy to do that. Just shoot me an email and I'll make an introduction. Thanks to everybody that came out. My one last question, and I haven't discussed this with anybody, and it's kind of a broad question, but when do you feel like we will be back to normal? By back to normal, I mean people able to go in the office, whether you want to stay, some of your workforce may want to stay remote. People able to go in the office, restaurants and bars are back open, people are back on planes, that kind of vibe. Just what's your prediction, Tom?
As someone who's on generally,
Tom gets to go first. He's the old seasoned vet, right?
That's right. That's I don't know if you can tell that by my lack of hair, my grayness.
Done that.
But for someone, Adam, as someone who's on a plane 3 or 4 days a week, I don't know that being back on a plane 3 or 4 days a week. I hope not for a while. But I think that's the question we're all searching for. I think we're going to see some form of normalcy by mid to late June, July. But what the new normal is, I think we might go into a restaurant and they have 40, 50% capacity because there's still social distancing in a restaurant and things like that. I think, as you've seen in the last 2 days, several governors are working together towards sort of a get back to work agenda. And, I think we'll know a lot more as those states, especially states like New York, Connecticut, New Jersey are really pushing in California. They're going to be the drivers of this thing. So I wish, like Jason, I wish I had a crystal ball to this, but I think our new reality is going to look different, whatever it is. But, I hope by middle of June, July, we're back to some form of people going back to their offices and things like that. So that was a long-winded, not much of an answer.
Perfect. John, what do you think?
I think I tend to roll with more the optimistic view on this. I think most people that I talk to, brokers, buyers, owners, sellers, are just on the street. People want to get back to work. Nobody wants to see this drag out longer than it has to. So I think the general consensus that I hear is that, people do want to get back to normal, but it will take some time. It'll be interesting to see what the governments say in terms of when they start to lift stay-at-home orders, what businesses can open up and to what extent, because I would imagine there's going to be some of that that's going to impact how we come back from it. But I'm thinking, probably mid to late summers, I think when we may start to see things start to normalize a little bit. I think there's just new realities, kind of like the post 9/11 thing of you're going to wash your hands a lot more. You're going to probably wear gloves more often. You're going to possibly bump elbows, or if you're at risk, you may not go certain places. I think there's just going to be kind of a whole new bunch of norms like that as a society we're going to get used to. But I still think that for the most part, what I'm hearing is people do want to get back to business as much as usual. So I'm hoping that, and what I'm hearing from my colleagues and some of our national managing director calls, the general consensus, third quarter, fourth quarter, we should start to see some sort of normalization. But, again, it may be a little too early to tell. And I think a lot of it's going to depend on how our politicians decide to phase things back in. Sure.
Jason, round us out.
All right. So the way I look at this is that I think that, I'm hoping that, by the end of the summer, beginning of next year, that we'll start, by the end of the summer, beginning of the, of the fall, we'll start rounding ourselves out of some of the issues that we've come through. I think that obviously stimulus packages and the folks opening up, people getting back to work is going to be, paramount. But I think the one thing for us all to think about is there's a couple different things that are happening, right? One is when you pump a couple $1 trillion into the economy, inflation will probably happen in some form or fashion, which makes our business even better. Something to think about. The second piece of it is that we all know, look at the last time there was a down cycle, there was a market hiccup. I think all of us have talked for the last year about what's going to happen in the marketplace. And we were like, okay, well, something might happen, to kind of cause a downturn, and nobody ever thought it was going to be a virus, but there will be a new market norm in some form or fashion. We just don't know what it's going to look like. And there will be changes to the way people operate, people execute, and people do things. I just don't think we all know what's going to look like. But, I think hopefully, we'll move ourselves out of this, hopefully by the, end of the fourth quarter. I mean, we're hoping that we're, back in full swing, in the next 3 to 6 months.
Yeah.
But
I tend to agree with that. I feel like the next 60 days kind of is going to be a slow trickle as far as getting back to kind of what the old ways were, and with some new ways. And it may be, if a restaurant had a 150 person capacity, now it's an 85 person capacity, and they just have to spread things out and things like that. But I feel like the second half of this year is going to be really back to normal in our business. And if anything, I'm they're talking about single family mortgages being harder to qualify for. So I think our industry is poised to rebound fast, like it did in comparison to some other industries of the last downturn, the retail, the office, that are getting hit a lot harder than we are at the current time. So anyway, thanks everybody for tuning in. Thank you to the panelists. Really appreciate it. Hope that added a little value for everybody, and we'll talk soon.
Thanks, Adam. Great
Luck,
job.
everyone.
Thanks,
Thank you.
everybody.